You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
This is Mining Stock Education. I'm your host, Bill Powers. Thanks for tuning in. Well, once or twice a year, I like to check in with Bob Hoye of chartsandmarkets.com. He's a trained geologist, successful resource investor, and he's an economic historian. So when he talks about things like the gold price, he puts it in broad historical perspective. And I don't just mean putting it in perspective of recent decades, but actually going back hundreds of years at a time. So Bob, with that introduction, welcome onto the show. And could you put the gold price, the current gold price, current gold action in historical perspective, please?
Yeah, Bill, be pleased to. I became fascinated with financial history a long time ago and did a full sweep. And you've got the big events in history for the last 300 years have been a great boom in commodities after, maybe 15, 20 years of solid economic growth. This would be a global boom in commodities, often associated with two major countries at war. Well, like, for example, 1920, following the First Great War. Then they go back in time, and what I've found was that about a decade later, the other great event develops, and that is a global boom in financial assets, stocks and bonds. And they're separated by about a decade. And the first great financial bubble, of course, is well known, the South Sea Bubble of 1720. And the previous global speculation in commodities was 1711. And then you go right through, as I said, here's another one. 1873 was a huge financial bubble. And the global commodities peaked in 1864. And this time around, to our work, the global bubble peaked a year ago, December, January. And that was a decade after the last peak in commodities, which was 2011. We kind of had a double peak in there, 2008 when crude went up to 147, and then 2011 when, silver went to 50, and, it was a pretty good commodity boom. And then a decade later, it brews up into a great financial bubble. There's events within each bubble that are common. One is that copper's real price goes down in the final year and a half or so of the bubble, which it did this time, as gold's real price goes down. And of course, gold's real price is deflated by the rate of inflation of the Consumer Price Index. I took it a step further and deflated it by the commodity index, the old CRB. And that then compares the costs of mining relative to the bullion price. So those are two items that are common to the completion of a great financial bubble. Another is that real long interest rates go up as the bubble collapses, and also the senior currency, the world senior currency, goes up relative to other currencies. So it sounds like a strange mix, but when you've seen it in the data going back to 1720, and then the next bubble was 1772, then it was 1825 financial bubble, 1873, 1929, and then ours. So we saw this in the completion of our bubble. Copper's real price did go up. Gold's real price did go down. And the senior currency became quite firm, speculatively. So the DX up to 114 in October. We were in the transition from a great financial bubble to what will be yet another, and I've used the term post-bubble contraction. One could use the term depression. But if you take a look at gold's real price through previous great, the post-bubble contractions, the real price tends up. And the key thing is that it tends up relative to the cost of mining. So you don't need a change in gold's nominal price in dollar terms. What you need is the cost of mining falling. So the next step I'm going to go from the consumer price inflation and then the CRB, basket of commodities, and if they're going down relative to the bullion price, it costs to mine things. And then the one that's really clear is when you compare it to crude oil. Now, not all mines are powered by crude oil or natural gas. Some are fortunate enough to have electrical or hydro. But nevertheless, about 60% of mining costs are related to energy. You got the cost of blasting, you got the cost of hauling those big earth movers and all that sort of stuff. So this is where it really, for a person just first looking at the cost of mining relative to gold, relative to crude oil, is very obvious. And in the last few months, it's up by about 50%, whereas relative to the CRB, gold's price is up by about 27%. So what I want to do is focus on this, because the gold bugs really first appeared on the scene in the mid-1960s, and James Dines did some good work in the field, and he was a good researcher all the way through. And the story has been that the U.S. dollar was going to go down. I've agreed with that because the Federal Reserve is crazy. I agree with that. But it was a rare view, say, in 1964, and then now it's a very common view. The point is that if any researcher looks through the history of the financial markets, as I've done, these things stand out. Now, a classic bubble has completed. The big chuff about inflation more recently is more due to the COVID shutdown and then the central banks going crazy with the money supply. But within it, this huge shutdown, the classic bubble did blow out a decade later, with the key items doing what they should be doing. So this is where I really like the gold sector, because the prices will continue to fall relative to gold, which means that the operating margins for mines improves. And I'll give you an example. Homestake, in 1930-31, you could buy the stock for $9 a share. It had underperformed in the 1929 boom because gold's real price was going down, although in U.S. dollar terms it was fixed at that $20.67 an ounce. And you take it to Roosevelt wasn't installed in office until March 1933, and he started experimenting with gold and eventually moved it up to $35. But if you take it to the end of 1932, no change in the price of gold, Homestake earnings were up about 130%, and the real price was up about that amount, 130%. And the stock was moving up relative to the S&P. So this is the other thing to look forward to in the sector, is that the gold stocks are not just going to go up, but they will more than likely outperform the S&P. So what I've done, and I really got excited about it in June when I thought, hey, let's go to the deflate gold by the CRB and see what it tells us. And what it told was gold was extremely oversold relative to the CRB, but using other features, we figured that it would take until September, October to get the low in for the gold shares that would end the bear market that started in 2011. And you're looking at the GDXJ, that really kind of worked out kind of nicely. Our advice then in June was that look for end of the bear market in, around October. And that did come in, and then we would be accumulating gold stocks, from big ones to little ones, depending on one's portfolio. And so what we want to look at here is, again, resort to Homestake. On that $9 purchase, eventually Homestake got up to $65 in the mid-1930s. And yes, Roosevelt did increase the price of gold to $35, which really moved the real price up hugely, and which was what was happening anyway. So all he did was reinforce Mother Nature. And Homestake's stock got up to $65. And in those days, gold miners paid out virtually everything by way of dividend. And it was paying $4 a share dividend on a $9 purchase. So, I mean, hey, that's making money. So this time around, in this forthcoming post-bubble contraction, the gold miners will be more interested in building assets rather than dividending out. And you can see with energy costs being about 60% of the cost of mining, how that one works. And it also flows over to gold prospects, gold exploration bets, because, hey, eventually if you're fortunate with an exploration play, it ends up as a mine, and then you got the benefits of relative costs. So I really, we're very bullish, and this lasts for quite a while. So the other thing is you look at it from the institutional side, and the big funds really don't have the patience for the gold market. It's even with the bigger cap golds, it's a small cap market. But if you get into a bull market where the GDXJ is outperforming the S&P, there's going to be some equity fund managers there that are where they may not normally buy golds. They'll say, hey, this is a performance wagon that I've just got to get on. So this would run for many years with some recessions and whatnot coming in. It'll become a very popular sector. So our view now is that one should be buying the dips, and we're looking to have a very good representative position and looking for not just gold shares to go up, but to outperform the S&P. Now, that's going to be a very happy circumstance, and depending on the size of one's account, you can go from the big ones right to the middle and size ones. And me being an old field geologist, I really like the junior exploration stocks. If you get a little portfolio of those, I can remember in 1996, I forget why I did it, but I just decided we'd put forward a list of 5 exploration stocks. One of them was Arequipa. Well, it went from pennies to was taken over by Barrick for, I think, $2 billion. So it was a huge gain, and you only have one of those. So we put together a list of about a dozen interesting juniors, ranging from kind of like pre-production, production, and with some what I think are pretty good exploration bets in there. You can get stuck with a dead one, but you only need to have 1 or 2 work out, and it saves messing around with buying gold futures or silver futures. We don't see much change in the price of gold, and in previous post-bubble contractions, silver really underperforms gold, so we wouldn't be messing around too much with silver stocks, but really do like the gold ones. And as I said, we've got a list of pretty good-looking bets in the sector, and I think the worst you can happen is you can get in a stuck one where you just get bored, and but you have perhaps a multi-year rise in gold stocks ahead of us.
So what would be the one thing that could throw a monkey wrench in this thesis? You've overlaid over our current day, historical precedent. But what was the most likely thing to go wrong, in your opinion, with this thesis?
If there is not a post-bubble contraction, the gold real price goes up in each post-bubble contraction. If you take the major gold rushes, Klondike, late 1890s, that depression went from 1873 to 1895, and I've got a list of the great gold rushes, and they have all occurred close to the bottom of a Great Depression, when many men are unemployed and the real price is high. Now, of course, they've really discovered all of the surface alluvial gold deposits, more or less. So the next great craze for gold will be, proper geology, field work, looking in new areas, and even chasing in old areas. But the gold market will perform. There's not very many researchers out there who have done the studies that I've done, and I'm convinced that the tide has turned from inflation in financial assets to deflation in most everything except gold's price. And even more recently, and using gold relative to the CRB as representing costs, or gold divided by crude oil That one's easy to see, because I said about 60% of mining costs are energy related. So it's happening, and the hits, of course, will be the sector getting overbought and going into maybe a 2 or 3 month correction. But it's going to be like the long bull market for stocks. You buy the dips. So buying the stock market dips for the last decade was a successful policy, and it flips and goes the other way now. And the success will be having a representative position in gold stocks and then buying the dips on a lengthy bull market. I'm very enthused about it. It's a field that I've studied for a very long time. I got my way through a geology degree in a couple of summers working for junior mining companies in the field, British Columbia, Northwest Territories, Yukon. It was fabulous summers and a fascinating subject. And then I made the mistake of making money on the first stock I bought. We were coming up with some very good drill results in the field, and I saved up $500 and went to a walk-in broker in Vancouver here and opened an account and made some money in the stock. I think I bought it at $1.17 in that February, and by May I was out at $5.25, and then it was that June when I started with Wood Gundy, which was Canada's premier investment dealer, and the stock eventually went to $7. So anyway, so that got me in the investment business, where I've been for a very long time.
And Bob, your website is chartsandmarkets.com. Remind listeners what they can find there.
Yep, we've introduced our service. Now, I do the historical stuff and cover all markets like the yield curve, base metals, precious metals. And my colleague Ross Clark is a genius in technical work, and he has some very fine approaches too. So the two go together very well. And so one side tries to look for a potential high or a potential low, and the technical side, when you get there, if it's really oversold, hey, your anticipations are working out. And this worked very well on accumulating gold stocks, October, November. And then they became overbought recently. It's just the same as the U.S. dollar has become oversold, very oversold. So there's some corrections in here, but as I say, in looking at the longer term, it is to buy the dips in your favorite gold stocks. And people, if want to get a list, we'd be very pleased to provide a list. And Ross is continually monitoring them for overboughts or oversolds and that sort of stuff. And some of them are small cap producers, and some I think, have great exploration potential. And we'd be delighted to share the list with anybody who is interested.
Excellent. Well, thank you for coming on today's show.
Bill, it was so good to chat with you, and look forward to another time, too.
Absolutely.